Hello, everyone, and welcome to the Dorsey Wright podcast. Today is Wednesday, February 5th. My name is Eric McCardle.
And I'm Steve Raymond.
And Steve, today we are here to talk about the FSM model updates that we experienced with the first seasonal quarter of 2020.
Yeah.
A lot of great changes. The market is continuously moving to all-time highs, despite a recent pullback, a little bit of heightened volatility in the past few weeks. But a lot of updates nonetheless. A lot of really interesting developments on the FSM side. But before we go into that, let's just kind of give our listeners, our watchers, a little bit of a framework for understanding what these FSM models are. And really, you're no better person to describe that, right?
Absolutely. The fund score method's been developed over the years. I think that some of the premises of that framework are really rooted in the idea of making things simple. How can we simply approach the market in I would think a powerful way, but still keep it simple so that the practitioner can remember what we're doing, and easy communication to the client, and provide focus, which is going to be probably one of the best return profiles over the long term, is that we are focusing down on the higher leadership of relative strength. Yet, in most cases, keeping quality high. So an average FSM model will have a very high pedigree of funds or ETFs in there. Typically, not a mystery about what those funds do.
Mm-hmm.
If I have a vote, I like big funds that are well known, well run, highly paid staff, so we don't have to wonder if they're going away or any other things like that nature. But typically, we pick a focus inventory of 2 to 5 funds on some frequency, which we may touch on again. But really, keeping it simple with the ability to kind of ride the longer term relative strength trends.
Absolutely. And you said keep it simple. And one of the ways that we try to keep it simple on the Dorsey Wright platform is by assigning scores or technical attribute ratings, right? And so as the name of these models implies, we're deriving our relative strength ratings based on the fund score, right? And the fund score, for those of you unacquainted, is going to be a comprehensive reading of trend and momentum characteristics, as well as relative strength against the market and the fund's peer group. That reading ranges from 0 to 6, with 6 being a perfect score. And so when we talk about using the FSM or fund score method framework, we're simply looking at an inventory, right, as we discussed a moment ago, and we're ranking by that fund score, on a certain periodic update, right? So, Steve, we've seen a lot of traction with these models since they first launched in 2016, I believe is the date. Is that correct?
Yeah, on the website, this website, we've got the published date of when they came up on this particular version of the website. We've been teaching FSM in seminars and in research, written research, back to 2012. But so for some years, this has kind of been the principal method of saying, hey, here's the thing to go do. Among the things you do, make sure that we're working with this one, because it's highly scalable, across clients, very quickly, to move in and say, hey, I can work with different venues, retirement plans or any size account, whether big or small, and still keep it doable.
Right.
Since we're dealing with, in general, just a handful of funds. So it's not only an excellent strategy, it's a great selling pitch and point, that your clients respond to. At least this is what I hear over the years, over and over again. And February, as we said, is kind of the big month that, to open a new year with. The prior seasonal quarter was November. Basically, we're breaking up the year into seasonality, May to November, November to May, and with those semi-annual breaks, we break those in half, and it gives us 4 quarters. But February is good to get to. It means you got through the last year, you booked your wins. Possibly the president has already given an inaugural update, and then we update our models. So somewhere in there is kind of how this goes. And we just had this update, and we kind of in the midst of some market turmoil. I will admit a lot of that turmoil so far is psychological, with the talking heads and the mixture of that. Our indicators, the core percentile rank, which measures how strong the S&P is against all assets around the world, the money market percentile rank, which measures how strong cash is against all those asset classes around the world, or you could say the risk-free rate. How strong is the risk-free rate? Maintained, kind of polar opposite levels. The core's been stroking along at 95, 96, 97-ish against all asset classes around the world. A very, very strong reading. Money market's been in the 2.5 to 3.5 range-ish, even through this turmoil over the last week. And so what that's telling you right off the bat is, the market's strong. We want to, we want to be invested, no question. And the risk-free rate is very weak, remains weak. We're not even considering, any cash issues or raising cash or need to play defensive at this point. Right, wrong, or indifferent.
Right.
That's what this does. The models are rules-based. They do what they're told to do, and at this point, it's full offense. I will make a mention that those groups that are above the S&P 500 in strength, in other words, they have a percentile ranking greater than 95, or at the 95th percentile, greater than that. Number one is technology. I don't need to explain that. Aggressive growth is number two. That's really an investment objective that some funds participate in. Sometimes it's a little bit of ethereal as to whether they're large or small, but you get the idea. Aggressive growth. Some funds have a stamp on that. They're number two, and really followed by large cap growth, mid cap growth. So that's your top section there, which I think is a pretty strong sentiment of where we need to be and what we expect. And I think we've held that alignment even through the recent market turmoil. Of course, that's now. As you may recall, the present becomes the past as soon as I say something. But right now, this is where we are, and this is where we've been, and so our mode of operation and the mode of the models is, we're going straight ahead. Nothing's been seen to even really comment on, other than that. And so, with that said, we do have ETF models. I think, what are some of the popular ones that you feel you hear?
Yeah, so when we're talking about the strength of the core, right, we've really wanted to make sure that we accommodate one or multiple strategies that follow that strength and allow you to tune in the right direction of core equity exposure. The first of which being Core Solution US. So very basic in terms of the inventory, and though I say basic, that does not take away from the power that is, made available to you given RS, given the ability to lean in those directions of strength that are core-centric. So, for example, you're looking at an inventory with SPY, RSP, QQQ, SPLV, right? Broad market funds, low cost, widely traded, right? However, they're great solutions, as the name implies, for that core equity exposure. And when we look at the changes that we saw here recently within that Core Solution US model, sold out of SPLV and bought into MTUM, momentum, right? So moving out of low vol, taking a little bit more of an offensive approach with that momentum addition to complement our current holding of the Qs, right? QQQ being technology top heavy, Nasdaq 100. So the Core Solution US model definitely showing a little bit more of an offensive posture given this market environment. One thing, before we shift gears a little bit on the alternate ETF models, we did release a ETF with advisor shares that tracks this this model, right? And that's ticker DWUS from advisor shares. So if you're looking to follow this model in an ETF wrapper, be sure to check that out. Now, shifting gears a bit, we look at the power of being able to focus on those core areas of the market that are showing strength. We dialed it into a little bit more of a granular fashion by looking at all cap world, right? And this takes the same concept, those broad-based, highly liquid, low-cost ETFs, but we give you the ability then to go into specific size and style exposure, as well as the ability to lean into international markets should relative strength dictate that. So within the all cap world model, the Qs maintain their position of leadership. However, we saw QQEW, the equal weighted Qs, trade out with JKE, large cap growth, moving in. So not too different of a trade there, all things considered, right? But something noteworthy nonetheless. This also is now in an ETF under ticker DWAW from Advisor Shares. So great offerings there. We see people using these for their core exposure, either individually or pairing them together, 2 holdings each on both models.
Yeah, I would say it's a must-have. The Core Solutions series was in some sense, put together, even abstractly to say, we've got to have a piece to the model that does pay attention to certain core-centric ideas. The core of the market really means the S&P 500 related type funds. Their mantras or mandates of the U.S. cores funds are in some sense set in stone. They have to own at least 95% of their total holdings of those funds have to be S&P 500 related, and so that's where you get that quality of that leadership if you're desired to head that way, which I certainly am. So core centric would mean that you're really giving deference to the upper large cap. To answer that question first, if we can't answer what to do with U.S. large caps, my next question is well, what can we answer? So we start there, and then all cap world fills out a little bit of the wings of that if need be. And right now we don't see any non-U.S. real strength. I think the latest market turbulence downticks some emerging market funds. With that said, Brazil's holding in relatively well. I've seen some China funds actually move up in strength well enough. But all cap world doesn't really do individual countries. It's more broader, like its emerging markets is as narrowed down as that would go. That's a preference. I mean, that's a design. By design, it doesn't go out into the different countries and try to trade those. You would have to do that on your own rather than use all cap world. But I think as a strategy, all cap world is among the strongest, I think well thought out and most desirable broad inventory that we've seen. And so those pieces not only are standalone models, which I do see a lot of people use them, but they also were designed to plug and play. So you plug them into other strategies that you do, when you have a space to fill. So the nice thing is when you introduce U.S. core and all cap world, whether following the website or whether through Advisor Shares, keep in mind that you're buying a couple symbols, if that, and you're introducing that into something else you're doing. You're not logistically putting yourself out. What I mean by that is we're not recommending, okay, let's buy another 27 funds or 15 funds to go ahead and achieve an objective. No, you're buying a couple funds that have a big impact on what the long-term output would be. But those are, I think, the 2 ETF models that would be mandatory to follow up with, and I think that just by what Eric mentioned, there was a shift from, in some sense, lower volatility back into higher momentum. A shift, you could say, ratifying growth, and in some senses following exactly what we see in asset class group scores, which is that's where the leadership is. I'm a big fan of low vol. So I would say you can use low vol in various parts of your models and keep a good eye on it. It's fantastic asset class. It just so happens that the modeling, the scores, have been telling us that we're actually moving into a little bit more of an aggressive angle here, not pulling back and getting somewhat safer and trying to put on the brakes. So I'm just letting you know that the relative strength wants to go forward in a little bit more aggressive way than where it was. And keep in mind that low vol has been a very important asset class for about a year and a half.
Yep.
Carried us through some big times. I have no doubt that we'll get back to that one day or another. But what we got to do is go forward, and so those are the changes that are made for 2020, and it's kind of optimistic. It's an optimistic. What the relative strength is telling us is to be somewhat optimistic.
Right.
And that's how you net that out. And you go with what is. If the what is changes, then we'll change that too.
Absolutely. Well said. And just to kind of wrap up with these core solution models, we've talked about U.S., all-cap world, both of which, of course, favor domestic equity exposure by design. However, we did introduce what we call our isolated international core model back in November of 2019. And this is for those of you who are determined to be in that international exposure regardless of what the relative strength may dictate. Keeping in mind all cap world will move you in and out as needed. However, if you do need broad market international exposure, this is a great solution for that. We did see a downshift moving out of emerging markets momentum, which not entirely surprising given the recent volatility in that space. Also shifting out of developed low vol, and developed markets have been showing some favor over the last few months to a year relative to their emerging market counterparts. With the trades that we saw in that model, we moved into developed momentum, ticker PIZ, and moved into emerging markets hedged. So shifting down in EM exposure, shifting up in developed. So again, that's a good solution for those of you who are determined to be in international equities, but have a broad exposure rather than regional, say with like a Brazil or country rotation strategy that Steve mentioned earlier.
Yeah, I mean this model in some sense was designed to buy and hold as a permanent part of the international scheme that you may, or there may be a requirement on you to have that. Keep in mind, you can also use it when you decide you need to beef up your international weightings. You can come to this model and pick it up in those times where you need to overweight international and pick up this, which I think is a fantastic model. This model was birthed out of a fair amount of debates, but I think the consensus for the purpose of the model is we want an international model that is on the field, that does international things. This is it. This is the one. The developed angle I think makes sense. But the model has the adaptive ability to get back up on emerging markets. When that proves to be, I'll keep in mind that the emerging markets are still fluttering around the 3 score line as a group. It dipped below 3 in the last couple days of the market turbulence. It will bounce up above 3 and may do better. But right now we just go with where the idea is, and of course the isolated international core you fit into the other two, the U.S. core, all cap world. You may say whatever percentage you desire. One idea would be I'm going to do a big amount of U.S. core, a somewhat lesser but big amount of all cap world, and then maybe a 5 or 10% position in international isolated, and all of a sudden you have a beautiful asset allocation model simply by tying the 3 together and let them ratchet underneath the ultimate sub holdings that would drive that pie that you would like to see. It's a beautiful concept, but more important, it's one of those concepts that work, and that's really the beauty of it is these strategies work. But that gives you kind of a good rundown of I think some of the main ETF portfolios to talk about.
Yep. Shifting gears into the international space, we saw some changes within our mutual fund lineup, moving out of areas of global international markets. Right now, not necessarily entirely out, but a little bit of a shift away. Right, we've seen these virus fears really weigh on emerging and developed markets relative to their domestic equity counterparts here in the last few weeks. As we've turned into this new market season, or at least a seasonal quarterly update, starting with American funds, right? We saw the American funds models sell out of small cap world and move into, at least in the 5S model, move into new perspective. So moving up in size, right, getting away from that small cap exposure to more of a large growth focus across global markets. In the 2 model, so a 2 holding lineup with American funds, we saw the same trade moving out of small cap world, moving into new economy, which is very similar to new perspective that moved into the 5 model, both focused on large cap growth global equities. So just moving up in size for those American funds models. Any comments on that model schema?
Well, I love small world. Sorry to see it go for the quarter, but it is an excellent small cap fund. Certainly those that want to dabble in small cap, keep in mind that small world is generally less risky than other providers' small cap funds, the way they over diversify the fund. I say that in a good way. But small world, and it was a close call. The scores were close, but the market's pretty clear that it's really the larger growth in the mid, that upper section of assets that has the win. And I don't mind this because, one of the things in constructing these inventories was in FSM, meaning fund score method, is to say, we don't want to own some of the more peripheral areas of the market unless they are extremely dominant. The close call is not good enough. I want over dominance, and so you could say that small world would have been in and would have stayed in if it was dominant enough to do so, which it was not. So that's okay. We let those go, and we'll come back around and see it another day. It's good to see new economy coming back up and showing good scores. Remember, that's very old American funds as well. Generally started as a really a U.S.-only fund, but as many American funds have become, they do have a global nature to them, how they're built now. But really, I think this is a U.S. dominant call. We could say global, but U.S. dominant call. And we'll see where things go in the mix, down the road. Again, if non-U.S. has more to offer, other funds will come in. Small World would be one of them, and of course, New World, which is quote unquote the most conservative emerging market fund in the world, could come in. But those that must be down the road. So what we got to focus on here is sticking with the new perspectives, the new economies, which in essence are dominated by the U.S. However, they're classified in some sense globally. And go down the road with that and be thankful that we have American funds, which really approaches their investment philosophy to apply a lot of diversity in these funds. So buying 5 American funds really diversifies your quote unquote pie quite well. And then from that point you move on to other focus areas. You could say, well, let me add some ETF core solutions and all cap worlds to that. Beautiful idea. And of course, a widely followed model here would be come from none other than T. Rowe Price, if you'd like to mention them.
Yeah, so shifting from kind of the low beta, over diversified American funds, which again, not a knock, we're huge fans of their shop, but switching to the stock picking T. Rowe Price funds, we've seen a similar shift down from that global exposure where we saw New Asia move out of the model for the 5S. We have seen continued focus on domestic equity exposure. In fact, the model currently has 90% of its holdings in domestic equity, with just shy of 5% in international or global markets. So, the focus on U.S. there with the T. Rowe model, and we saw dividend growth move in recently, right? We've seen those blend names perform well in 2019. T. Rowe, I don't want to say notorious because that's the wrong way to put it, but well known as strong stock picking shop. So, that's a fund that has certainly been strong, and to see that added in, just kind of solidifies the offensive posture that we have as we continue down into 2020.
Yeah, keep in mind that T. Rowe provides the focus and what I would call focus management. Things could be said. I think we've said them. You may have said them. These are the best focus managers on the street, and they have been, and they carry that tenure and that pedigree with them, and that's a good use case as you need to add focus to your total allocation needs. T. Rowe comes in on the focus part. American Funds comes on to provide the diversity to fill out those types of needs. They're harmonious when used together because they're quite different as a shop, as a culture. We like those differences, and that's why we try to look at models and point out things that are not just the same thing stamped over and over and over again. My desire would be that you buy funds and ETFs that you're buying for a reason. They have distinctive benefits, not just cramming things into a bucket to see how they can dilute each other. You're actually using these for a purpose. And so, T. Rowe will, and is maintaining that focused efficiency, and I certainly hope that you're using them and enjoy using them. I also advocate that, you take a look at some Vanguard products, FSM models. Vanguard's a great index shop. Their culture and the way they approach things is different than American Funds and is different than T. Rowe, and I think that's what makes the use of them probably beneficial, and they're not taking sides and they're not doing a lot of so-called stock picking. They're working, they're providing, access to possibly bigger block areas without a bias, of the stock picking or things like that. And I think that can be helpful. In fact, I remember, well, I'll just sum it up. Some years, Vanguard, does really well, and then a year the indexes don't do so as well as active managers, and then the next year they come back and do well. Mm-hmm. So it gives you something to, counterbalance some other things that might be going on in the portfolio. If you put all your eggs on, one form of stock picking, well, it might all not work. Right. For a year or so. Whereas if you're using these strategies blended, you can have some things not work, but other guys are picking up, other shops and other cultures are picking up, the steam and making it well worth it. So, the Vanguard does play well in the FSM world with this methodology, and not to mention that they have a low cost, as everyone likes to banter about. I would be one that I don't mind high cost as long as I'm getting what I'm paying for, and what you're paying for with the higher cost maybe of T. Rowe and American Funds. You're getting those managers, see, which I think is very important. And the low cost, that works its way in there as being very helpful. So you have a story to tell your various clients. Yes, you're using somewhat low cost, moderating the cost, but not to the point where you're cutting out the managers that you need. So I think the blend of these makes for a fantastic game plan.
Well, and on that point of having the management prowess of an active manager like T. Rowe or American Funds in counterbalancing, we saw dividend appreciation move out of the Vanguard model, whereas dividend growth moved in the T. Rowe. So, maybe something more along the lines of a testament to the stock picking prowess of that shop. Within Vanguard, we also saw utilities move out in favor of U.S. growth, so large growth, of course, and the Vanguard 500, so S&P 500 index exposure, which is right in line with our core observations that we made earlier in the podcast.
And I'd like to jump in and make a note that these models updated in essence at midnight on February 3rd. Just as a point of reference, this is before the big market up day. This is before the big market up day. So I don't want to have anyone think, the market moves up very profoundly and now we're picking some fun. Now, these changes that are finally in place on 2-3 they were kind of there well before 2-3, which is well before the big market up day. In other words, utilities fell out because that's where the relative strength was leaving. In some sense, before the talking heads said utilities are falling out because of the big market up days. I don't know if that's a big point. I just thought I'd mention it. That and sometimes sometimes the days we update or surrounding the days we update is some market noise. We contemplate that. I don't want you to say that think that we don't think about that. But the game plan is pretty simple. Is that we have appointed times to show up. and we show up, and we go with what is, and we say to ourselves, this is what we're doing. We tell our clients we're doing this. This is the quarterly game plan. In most cases, we do have monthly models, but this is the plan for the quarter. We do have defensive mechanisms that are active intra-quarter looking for things, but most quarters things don't show up that are defensive, right? And so we don't want to only harp on that, but we're in higher momentum, large growth, mid growth. There are some unique opportunities. I don't see a lot of small cap in these iterations. Like we said, some of the value in the utilities, fell out, and it tends to be an optimistic sign.
Yep.
And that's kind of what you say from here to May. This is the bedrock of what we're working with. And now, of course, as of 2/3 and 2/4, and of course you're listening to the podcast the very week of, just a couple of days after. Now's the time to get the message out. Let's go ahead and get loaded up, and we keep going. I think there were some fixed income updates. Did you have something on that?
Yeah, so we look at the most popular fixed income FSM solution, the Franklin lineup. Franklin Income moved out of the model, and we saw Franklin Emerging Market Debt move in. So that's interesting in that, Franklin Income is kind of a multi-asset income strategy, does have bonds in there, of course, as the fixed income, universe suggests. But to see emerging markets move in was pretty interesting, in terms of what we've seen across the market, with more of a risk-on approach in the fixed income asset class, broadly speaking. And that's going to join convertibles, which is another very similar posture, right? So definitely, investors are showing signs of putting money to work in those riskier areas of fixed income, which bodes well for the observations we've made before about carrying over into the equity markets and the risk-on posture there.
Yeah, I'd like to make a comment. I don't want to say it wrong, but the emerging market debt asset class does have a fairly strong correlation to U.S. high yield. As Eric mentioned, the convertibles are really leading the pack, and that's more of a U.S. play. And the reason I wanted to make a comment is I often see the emerging market debts get stronger in advance of emerging market equity. Sometimes well in advance. Like, I'm not talking days, but somewhat months in advance. So I think it's a good sign to see the emerging market debt come into the area. That doesn't mean the emerging market as a whole on the equity exposure is sound, but it doesn't mean it's not. So I would take the emerging market debt play. I think that's an optimistic play. I think the relative strength is certainly there, and that gives you an option to have some international exposure. Although in this case it's debt oriented. And this may turn into something, so be optimistic about that play. And of course, Franklin Income Fund, I think it got cut loose on this round. Many of you use it. We always have. I mean, this is one of the oldest high yield equity kind of what they call hybrids. Back in the old day, I think we called it a hybrid. I'm not sure if we knew that word, what that word was. Fabulous fund. It is built to carry loads. You can put whole books on that fund. And keep in mind that when it gets knocked out of an FSM model, doesn't mean it's bad. It just means it got knocked out, edged over by something with stronger relative strength. I think Franklin Income Fund's a great go-to horse fund. And I don't want to ever, forget it. And if I need it, you can use it elsewhere. It's just it's been eclipsed a little bit by the power of some of the other funds that Franklin is managing. And let me just say that Franklin has been an outstanding, what I would call classic fixed income manager for decades. You could say more than decades, which is important because that classic way to approach fixed income. You would think every shop practices, a classic method. Sometimes I call it a common sense method. But there's a lot of high science that goes into fixed income sometimes these days. And sometimes when you buy a fixed income fund, you really can't understand what's going on there. This is my take on it.
Yep.
And that doesn't mean that's bad. It's just, whatever happens, you won't understand what's going on there. Whereas Franklin, I think you really do get it. The name is this, we get that.
Yep.
It's more of a classic textbook way to do bonds very well by a very highly competent desk. And I appreciate that. It's not that I don't appreciate other ways to approach fixed income, but I do think it's important to have that before that classic style gets lost out there in the horizon somewhere. Franklin's done well there. I think we've pioneered, our way into providing answers in the variable annuity market. I think that's something we wanted to do, and I think we're getting better and more courageous at interacting with those universes and trying to look at product. Eric, do you have any opening statements maybe for our variable annuity work?
Yeah, absolutely. And as you mentioned, we've been putting a lot of thought into this chassis, into this investment vehicle type, because we know that there's a lot of money out there, right? And in some cases, a lot of stagnant money, something that had been set up in the past, something that had maybe been overlooked or kind of pushed to the corner of a book of business. But we think that there are ways to add value there. And what we've looked to do over the past, really few months, but you had even been doing this before with Nationwide's lineup. We've taken a look at Jackson, where we've combined the Perspective and Elite Access inventories into a common inventory for a top 5 seasonal quarterly solution. We've also been putting a lot of emphasis on Lincoln's lineup here recently, and Lincoln has a couple of different solutions. One of the nice things about the Lincoln product in general is the ability for you to pick your sub-accounts regardless of whether or not you have an income rider attached to it. That's something that is a nice benefit with them. A lot of shops or a lot of contract firms are going to require that you kind of play within their sandbox in terms of having that income rider attached, which we know a lot of those annuity assets do have such riders clipped on board. Within the Lincoln lineup, we have Choice Plus, which is probably the more popular version, and we're working on something with Investor Advantage where we're going to look at a fusion, what we call a fusion model, which is pairing not only the FSM framework, which we've talked about in depth today, but also a more traditional version of relative strength analysis using Dolly, right? So more of our tactical tilt framework. And pairing those two things together. So that's something that we're looking to have out to you all in the very near future. So just wanted to drop a little bit of a teaser on this podcast today.
Yeah, and so 2 points. I'm really happy we're pursuing the variable annuity market, and we have more coming. I envision working with 3 or so shops, and then having some great product, because that's a ton of money that you can get moving, and I think into your corner. Mm-hmm. Get the term 35s and let's get this money in models, doing a great job. That's the storyline, rather than sitting out there and no one knows what's happening, or so it's a good time to prospect for pools of money. Eric mentioned FSM Fusion, which I think is an important thing to make a comment on, is that that will be a new brand name that applies to when FSM is coupled with a different strategy. So, you can run many FSM models together, like the tortoise and the hare. Some people put core solutions with American funds, and we call that FSM because it's, in a sense, the same methods being applied across different vehicles. In some cases, funds, mutual funds, whatnot. But FSM Fusion would imply that the FSM method is fusing with a completely different method. In some cases, FSM Fusion could apply to another strategy that we can't even think of, or that I don't want to say right now. But in this case, the fusion is with Dolly Tilt, a very popular relative strength method that has its own mechanisms of determining relative strength and its own mechanisms of offense and defense, meaning different than the fund score method. But the idea there would be the same diversity of strategy. In other words, I don't want to just use only one strategy. Maybe it's good to have some alternative strategies or slightly different strategies or very different strategies. And so I'm excited about the FSM Fusion unveiling to see where that would lead. But we're going to start with this one, which I think will be hopefully a popular one. I can think of 2 shops in variable annuities that we're going to try to work with there. But at least one.
Yep.
But I think it's going to be 2. And so we're happy about that. I want to mention that we do address areas of interest in FSM, and sometimes we don't mention them all when we sit down and do a video or a podcast or whatnot. But keep in mind, we try to take care of all the equity dominant strategies that one would think are important. We try to look at the 401k or the retirement programs. We try to look and have models on the variable annuity programs. I also want to mention we do have an ESG dedicated model, which is really focusing on the ETFs and the mutual funds that have been in the space. I don't want to join the talking heads by saying, how do you define ESG? Because they say they don't know. One way we do, and again, my particular bias is I work with socially responsible themes that have been around for decades. So they're rooted in the fact that they invented the space. Those mutual funds are included in what we do, and of course we rely on other purveyors like a Morningstar and others to help us understand what funds are built for this space and are in the space. And so we are doing that, and I think it's an excellent model. I've gotten rave reviews on people using it, and of course we may have a version 2 or different versions of that coming out. We also pay attention to self-direct brokerage accounts. Like for example, you're dealing with someone and they have access to a retirement plan and a self-directed brokerage account, and you're saying, well, I need a strategy for that. I don't want to leave that unturned. I don't want to leave that undone. As I recall, we have a First Trust.
We do.
Yeah, explain that a little bit.
Yeah, so that First Trust is an ETF model, top 5 seasonal evaluation, and it's a go anywhere. So very similar to the potential exposure one might receive in some of the mutual fund models that we mentioned earlier. However, using that First Trust ETF universe. So the other benefit to that model, Steve, is it has sector exposure in there, which I believe is spare a few exceptions where we have utilities or real estate or science and tech. This is really going to be the one that gives you the most ability to lean in those different sectors of the domestic equity market. So that's a really popular model. We have seen some changes with the quarterly update where we had, let's see here, mid-cap core moved out, clean energy moved in. So really interesting on that front, right? Because we know how much of a laggard energy has been broadly, right? We've seen oil, move into bear market territory here over the past week, and a lot of the traditional energy names struggling with that commodity slump, so to speak. But we're looking under the hood of the energy space on asset class group scores, we see the top names are in that clean energy arena, right? Whether it's wind, solar. So very fascinating to see that be able to battle its way up through a pretty diverse inventory in that First Trust lineup and make its way into the model.
Yeah, it's kind of a, well, there's a couple topics there, but I'll just pick on the 2020, the green year, maybe. We want green cars, we want clean energy, we want to get on that front wave, and maybe indeed we are. So the First Trust Self-Direct's a great model to follow, and that's what we're seeing there. The ESG, you certainly want to be on top of, but I think that ultimately you're saying that when you move into FSM land, you're hopefully not seeing too many models, but hopefully seeing use cases. I want to use this for that use case, I want to use this other one for other use cases, and that you're not left without an answer when someone says, oh, but do you do this? Yes, I do, is really the answer. That you're able to say, I'm bringing high-quality funds with a high-quality strategy that's simple and easy to repeat and scale. You don't have to tell them that part, but the part is you're able to bring the answers. And so, our goal is to make sure we have a menu big enough to address the needs that you would have. And if you're new to FSM, or you've already been using maybe some favorite models, keep in mind that, take a weekend, go through the whole list of the model inventory, get familiar with some of the objectives and use cases of some of the other models that you may not have looked at. I think they'll be very helpful, and it's certainly great stories to tell to get your clients interested in as you're ascertaining which of these fine products would be the one that they'll need to own. You can talk about the widespread methodology and the different places you could go. And I'm glad we mentioned the ESG and the clean energy, because that's just another buzzword. What do you mean? What do you mean by that? I want to hear more about that. I think that clients and talking heads and what's permeating through the atmosphere in 2020 is I think ESG is as everyone else says too. It's a big growing area. That's where a lot of inflows are going, and I think that's you got to have an answer there.
Yep.
And I think that Dorsey Wright also has ESG stock model.
Yep, that's
there.
right.
And so, it's not just only FSM, but there are plenty of things to do. Keep in mind that I think that again, this quarter, the February update lasts till May. The quarterly models, there's not going to be another update unless something changes in what I call the OD, the offensive defensive nature of the indicators. I don't presume that there will be any changes in that, but I will point out to you that I have no idea, right? But I don't presume there'll be any of that. So we're going on and we'll touch base on some monthly models. We'll touch base on quarterly. I've heard maybe more videos or podcasts addressing the subject of FSM. A fair amount of folks want to hear more about it, learn more about it, get more immersed in it, and we're glad to do that. Any other areas I forgot?
No, I think we pretty much run the gamut on this. We've gone all over the FSM model space and really covered what is happening in the market, what's happening on the model's listing page, and giving you some insight as to how we think about these problems and trying to find solutions for you and your clients. So with that said, thank you for the continued feedback you give us. It gives us, an additional guiding framework for how we can think about the problems that you all are facing and find those solutions to help you win business and manage your book efficiently. If you are looking to learn more about FSM models or anything FSM related, we do a fund score overview piece that comes out in the daily equity report on the Nasdaq Dorsey Wright platform every Thursday and Friday. Additionally, we have a fund score model guide, which is found under resources and prospecting. So if you are interested in learning more about these models, if you're interested in learning more about how to slot them into your business and use them efficiently, the other option is to just give us a call or send us an email. You can call us here at 804-320-8511 or email us at dwa@dorseywright.com. Always happy to hear from you all to make sure that we're working on the same team and getting across the finish line. So, Steve, with that, always a pleasure. For you all, thanks for listening and watching. We'll talk to you next week.